Welcome back to Investing Talk Podcast. This is host speaker, and we're here for another deep dive.
Good to be here.
Our mission today is, well, to unpack what's been happening with a major North American bank. We're looking at their recent performance, strategy, and some significant risks, all based on their latest quarterly reports and related documents.
Yeah, we've got quite a bit to go through: earnings, risk management structures, even down to things like executive pay.
Think of this as your shortcut, really, to understanding what's going on inside this pretty complex institution. Okay, let's unpack this. Starting with the financial snapshot. Second quarter 2025, first half of the fiscal year. Now, if you just glance at the headlines, wow, big reported net income numbers.
Over $11 billion for the quarter alone. Looks very impressive on the surface.
But those headline numbers, they don't quite tell the full story, do they? The sources really stress looking at the adjusted net income.
That's right. You strip out certain items, and for the quarter, that adjusted number is way lower, around $3.6 billion. And year to date, it's just over $7.2 billion adjusted, compared to, nearly $14 billion reported. Big difference.
And that massive difference, that huge gap, the source material is crystal clear. It's mostly driven by one big thing.
The sale of their remaining stake in Charles Schwab Corporation.
Right. That sale brought in, what was it, about $8.6 billion pre-tax in this past quarter?
Correct. So it definitely boosts the reported number, but it's a one-off. It's not really reflective of the ongoing sort of core business.
Okay. So if we look at adjusted diluted earnings per share, often a better measure of that ongoing performance, what do we see?
There, you actually see a slight dip compared to last year. It came in at $1.97 for the quarter versus $2.04 a year ago.
And year to date?
$3.99 year to date compared to $4.04 last year. So yeah, on that adjusted basis, earnings per share are down just a bit.
But that Schwab sale wasn't just about the income statement, was it? It had a pretty big impact on their capital position, too.
Oh, definitely. It significantly boosted their Common Equity Tier 1 capital, CET1.
Which is that core measure of financial strength, ability to absorb losses.
Precisely. The sale added about 238 basis points to their CET1 ratio. That's a really substantial improvement for their stability, their regulatory standing.
Okay. Shifting gears a little.
Yeah.
Revenue, net interest income, non-interest income. There was something interesting about their net interest margin, NIM.
Yes, the sources point to the impact of some U.S. balance sheet restructuring they've been doing.
NIM being that key profitability metric, the spread between what they earn on loans and pay on deposits.
Correct. And their reported NIM actually ticked up to 3.00%. Adjusted was 3.04%. That's higher than the previous quarter, largely because of this U.S. restructuring.
And they expect that trend to continue.
The expectation noted is for substantial further expansion in NIM in the third quarter. So some positive momentum there.
Okay, so the financial picture is, well, it's complicated. Big reported numbers from the sale, stronger capital, but slightly lower adjusted earnings, even with some positive NIM trends from strategic moves.
A mixed bag in some ways.
Now let's move to something absolutely critical for any bank and something the sources really dig into: risk. Navigating the risk landscape. How do they even structure their approach?
Well, they have a formal framework. It lays out defined major risk categories.
And it's a long list: strategic, credit, market, operational risk, which they actually split in two now.
Yeah, one part excluding data, technology, and cybersecurity, and one part including it.
Then there's model, insurance, liquidity, capital adequacy, compliance and legal, financial crime, and reputational risk. Phew, that covers a lot.
It does. And what's really telling is that they've recently changed this structure.
How so?
Financial crime risk. It's been elevated. It's now a standalone major risk category, separate from compliance and legal. And as you mentioned, operational risk was formally split.
Why do that now? What does elevating financial crime risk like that signal?
Well, it clearly signals a much higher focus, a greater prioritization of that specific area. It suggests these risks are either, growing or they're facing significant challenges there right now.
Or maybe both.
Or both, yes. It requires more dedicated, distinct attention from the top.
And the sources give us pretty strong clues about why this is happening now. They mention publicly known risk events connected to other risks.
And they link it directly to elevated regulatory scrutiny, particularly around anti-money laundering AML controls. specifically in their U.S. operations.
AML, preventing money laundering, terrorist financing, that's the context.
That's the key context here. These AML issues seem to be a major driver behind re-emphasizing financial crime risk.
And it's not just changing category names, is it? They've made governance changes too.
They have. A new executive committee was set up, the Remediation Subcommittee of the Enterprise Risk Management Committee. Its whole job is overseeing the response to enforcement actions and the required fixes, likely tied to these AML problems.
A dedicated committee just for the cleanup. And what do they expect as they sort of work through this remediation?
The documents state they actually expect an increase in identifying reportable transactions. Basically, as their detection gets better, they'll find more stuff.
Which sounds good,
But it will lead to an operational backlog in financial crime risk management. It just highlights how deep and complex this cleanup effort is. It's ongoing, needs a lot of resources.
Okay, so dealing with these big risks, like AML is clearly front and center, it's influencing structure operations, but banks also need to think about efficiency, growth. What about that side?
Oh, absolutely. Their strategic priorities, as laid out, include things like evolve the bank, simplifying how they operate, strengthening capabilities, and also innovate, redesigning processes for efficiency.
And they've launched something specific on costs.
Yes, a new restructuring program kicked off in the second quarter of 2025. The stated goal is cutting the cost base, getting more efficient overall.
What kind of costs are we talking about for this restructuring? Layoffs, office closures?
The sources mention primarily real estate optimization, so maybe closing branches or offices, employee severance and other personnel costs, yes, and also asset impairment.
And what's the price tag for this? And the hoped-for payoff?
They're projecting total restructuring charges between $600 million and $700 million pre-tax, spread over the next few quarters.
Okay. And the savings?
In return, they expect about $100 million pre-tax in savings this fiscal year, 2025, ramping up to fully realize annual savings of $550 million to $650 million pre-tax down the line.
And those savings, do they involve job cuts?
They do. The sources mentioned the savings include those from about a 2% workforce reduction.
So you really see this tension, don't you? On one side, huge focus and likely cost related to fixing risk issues like AML.
Potentially billions over time, yes.
And on the other side, they're launching this major program specifically to cut costs and boost efficiency. It really paints a picture of the tightrope they're walking.
That tension definitely comes through in the materials. You see it impacting, well, everything from day-to-day operations right up to leadership and governance.
Speaking of leadership, let's talk about governance, accountability, and the people in charge. How's the board responding to all this?
The sources suggest the board's been quite focused on refreshment, bringing in new people, strengthening expertise, especially in areas like global banking, governance, risk management, and importantly, regulatory compliance.
And that focus shows up in board committee changes.
It does. They've shuffled committee memberships, appointed new chairs. The explicit goal mentioned is enhancing oversight of critical risks, particularly AML. The governance is adapting to the key challenges.
We mentioned accountability for the AML failures earlier. How did that actually hit executive compensation?
The sources are pretty blunt. They say accountability reviews happened because of the AML issues, and these reviews clearly impacted exec comp outcomes.
And there was a big change at the very top, too.
That's right. Mr. Masrani retired as CEO, and Mr. Chun was appointed Group President and CEO effective February 1st, 2025. That was actually an accelerated transition.
And Mr. Masrani's compensation on his way out. How did the AML stuff factor in?
The documents highlight a really significant reduction. His 2024 total direct compensation was cut by 89% compared to the prior year.
Wow, 89%.
Yeah. And they also mentioned he's staying on in an advisory role for a bit, getting a fee, specifically to help with the AML remediation during the transition. So a very clear link between the issue and the financial consequence for leadership.
And are they using compensation to push for progress on fixing things for other execs?
Seems so. There's a specific example given for Mr. Salam. He received a Restricted Share Unit Award, RSU.
A type of stock award.
Right, but this one is explicitly tied to meeting specific AML remediation conditions and milestones, so his compensation is directly linked to hitting those cleanup targets.
Interesting. And the sources talk about their general philosophy on exec comp too, right? Beyond these specific cases.
Yes, a key principle, they state, is designing plans to avoid excessive risk-taking. They mention processes like challenge committees, review by the chief risk officer, all aimed at making sure pay structures don't accidentally encourage people to take bad risks.
Okay, let's shift perspective a bit. What about external views? Stakeholders. The sources mentioned some shareholder proposals.
Mm-hmm. Even ones the board recommended voting against. Which is interesting because it gives you a peek into what some shareholders are focused on beyond just the financials.
Like what?
Proposals mentioned include things like adopting a voluntary code of conduct for generative AI, disclosing an energy supply ratio, and pushing for public country-by-country tax reporting.
So AI ethics, climate-related disclosure, tax transparency.
Exactly. While the board argued against them for various reasons outlined in the source, the topics themselves show that broader ESG and ethical concerns are definitely on some shareholders' minds.
It shows the conversation is wider than just the bottom line.
It certainly does. And the bank itself, in the documents, makes a point of stating its commitment to human rights, opposing modern slavery, and highlighting its ESG efforts, like targets for sustainable finance and goals for financed emissions.
Anything else on stakeholder engagement?
They also mention efforts in customer service, like providing service in multiple languages across different channels, trying to show they're focused on accessibility and diverse customers.
Okay, finally, let's zoom out. The broader market context, looking ahead, what's the economic backdrop mentioned?
The outlook noted includes, well, the usual suspects lately, the impact of U.S. tariffs, the challenge of rising inflation, and just how tricky things are for central banks globally right now.
And how has the bank's stock performed through all this internal and external noise?
The sources do acknowledge stock price volatility over the last 6 months, and they directly link that volatility to the ongoing regulatory cleanup efforts, especially AML, and the high costs associated with fixing those problems.
But despite those headwinds, overall results seem to have held up, partly because of that Schwab sale we talked about.
Yes, the capital boost from the Schwab sale certainly helped. It gave them flexibility, maybe for things like share buybacks, which can support the stock price during challenging times.
But looking forward, what's the main risk factor that keeps coming up in the source material?
It's clearly the ongoing regulatory scrutiny and the significant costs tied to remediation. That's highlighted repeatedly as a major continuing risk. Successfully navigating that is crucial for them.
So bringing it all together, what does this all mean? We're looking at a major bank juggling a lot. Core financial performance is okay, helps by a big asset sale, but adjusted earnings are slightly down and they face these ongoing significant costs.
And at the same time, they're grappling with these very serious, very public risk failures, especially AML, that's forcing changes in risk structures, governance, leadership, even pay.
And on top of that, they're trying to become more efficient through a major restructuring, while also responding to these broader stakeholder concerns about ESG and ethics.
There's definitely this fascinating tension, trying to drive the business forward, cut costs, innovate, while simultaneously having to invest massively in fixing past mistakes and strengthening basic controls.
It really raises an important question for you, our listeners, to think about. When you look at a big bank today, how do you weigh its financial results? The profit, the revenue against its track record, and progress in managing these non-financial risks. Things like compliance failures, cybersecurity, or even how they handle ethical questions around new tech like AI.
Where do you place the emphasis? It's a key question in today's environment.
Let us know what you think. Please subscribe, like, and comment. We'd love to hear your thoughts or what you'd like us to explore next time.